Topic A tonight, a fabulous stock market rebound this week from corporate profits, hopes for growth, and ultra-easy Fed money. That is the big story. The Dow surged 362 points for the week, or 3%. The S&P up nearly the same. The Nasdaq up almost 4%. And get this, even with all that's happening in the world, the VIX volatility fear gauge has plummeted almost 40% over just the last 7 days. Tonight, we'll examine all the potential positives and all the potential pitfalls as we try to guide you, the investor, into next week and beyond. Let's go right to our market panel. Here now is Michael Cuggino, President and Portfolio Manager of the Permanent Portfolio Funds, Lee Munson, Chief Investment Officer at Portfolio, and Martin Weiss, President of Weiss Research and author of the new book, The Ultimate Money Guide for Bubbles, Busts, Recessions, and Depressions. Lee Munson, begin with you. When we last talked, I think you were 100% in cash. What do you think of this phenomenal market rally? Have you changed your tune or not? You tell me.
No, well, you have to understand, Larry, I went 100% cash in my hedge fund, which is global macro. So you have to think about it this way. I think the S&P has done what it's going to do between now and the end of the quarter. What I think is going to happen is that we're going to rotate sectors, and you're just going to churn it between one sector to another sector. So if you're just trading the S&P, it's a done deal. You hang it up, you go hang out, you ring the cash register. But if you're an investor and you're still long stock, I think you should look at things that have hit highs, like, for instance, a Ford Motor Company. I think it needs to be sold. I think you need to buy some other things. On Monday, I mentioned that people should look at American Mobile Tower, up 5% for the week. I think it'd go higher. So I just think you got to rotate your stock, no pun intended.
Mike Cuggino, what happened this week? What is your explanation for really, I think it's fair to say, a rally that almost nobody anticipated?
Well, I think that the previous week, you had a lot of people maybe looking for an excuse to sell after the run we've had, and some serious reasons in Japan, the Middle Eastern political issues, etc. And I think what the market realized this week, and we'll see how long this belief lasts, but that, despite all of these negatives out there and things that we need to pay attention to, the macro global growth story is still intact. The growth story is still intact here in the United States, and providing corporate profits remain strong and U.S. companies continue to outperform, that bodes well for the market going forward. However, I do think that, we're coming up to another inflection point here with Q1 earnings beginning to be reported, in a week or two here. And without those earnings, the stock market could fall. So that's a key thing for investors to watch.
All right, so you're hedging your bet. You're being very realistic. Martin Weiss, I want to ask you, can this kind of rally last?
Yes, it can last for a while because the Fed is pumping money. But remember, not much of that money is really going into the U.S. economy or the U.S. markets. It's fleeing into virtually everything else. Silver, gold, the Japanese yen, even places where you wouldn't expect it to go. It's going. And that's not long-term bullish for the U.S. market. If anything, it implies, it raises the question, what happens when the Fed slows down or starts cutting off all this free money that it's been pumping in?
I mean, Marty, when you look at the charts, it's so interesting to me. You get your GDP report today, came in a little better, 3.1%. Economic profits, the broadest measure, profits up 18% year on year. If you go all the way back, Martin, to the beginning of the rally in early 09, basically profits and stocks on a monthly basis and so forth is up about 70%. I know from the bottom, stocks are up a little more, but they go lockstep. And in fact, Martin, I want to ask you this and open it up to everybody. It's profits, it's stocks, and it's commodities. They're all going up together. What is the principal reason for that?
The principal reason is this entire recovery, or most of it, is bought and paid for by the Federal Reserve and the federal government in general. And we have had, just this last week, several senators come out and say basically what we've been saying for a long time, and that is that unless Washington makes an about-face, an abrupt about-face, the entire country is headed for a financial Armageddon of biblical proportions.
Biblical
This is serious.
Biblical? What are you talking about? If they turn off the tap right now, all that's going to happen is that the money that's flowing into these other areas like T T-bills and long bonds. And I'm sorry, Michael, but all that money flowing into gold, I think it's going to, and I'm talking about Cuggino.
Listen to what David Walker and his association
Where's the money
has said today.
Flow? You don't need Q3.2 or Q3.3 to rise the stock market. Profits are going up. However mediocre they might turn out this year, profits up, stock market up.
But that's
Bonds
a key
may
point.
die without
That's a very big assumption, Lee. Let me get Cuggino back in here, Michael. Can the stock market continue if the easy money, the ultra easy money tap is turned off? Because that has to be an integral part of what happened today, what happened this week, what's happened for almost 2 years. Profits, yeah. What about Fed credit? How important is that going to be, Mike Cuggino?
Well, I believe the profits are sustainable and real. There's no question that the rally's been driven by corporate profits, number one. Number two, macro monetary policy. Absolutely. I would probably put myself in the camp of Don Fisher, who I thought gave an incredible interview early this week, basically saying that the Fed's monetary job has been done. They can't do any more to affect things, and it's time for fiscal policy to step up and take it from here, and that monetary policy has limits. And I think, the market, being counterintuitive for a second, the market may even appreciate that if we get real on that side of the ledger. And we pass comprehensive tax reform. If we get serious about controlling the budget,
but there's
then we can take
gridlock in Washington. That's a very good point that you raised. By the way, Richard Fisher, the president of the Dallas Fed. But you're right. Washington matters. All right, Michael Cuggino, I'm going to go around. I see gridlock on spending cuts. I see gridlock on business tax cuts. I see gridlock on repatriation. We're going to talk about this over the course of the show. The Bush tax cuts were extended, yes, but I worry about the cheap dollar and the rising inflation choking them off, Mr. Cuggino. Are we really getting help from Washington?
Well, I agree, and that's why you hold some potential inflation hedges for down the road like gold. I still think gold has room to run. I think we're going to get help from Washington from the standpoint that even if it is a standstill, that's better than what we had the last couple of years. And, the economy has still begun to grow in spite of itself and despite all that. So I think that even if we don't get much help from D.C., we still can grow at maybe albeit a slower rate.
Lee Munson, let me ask you, you look down the list this week. It's really the reflation cyclical growth play. Energy, tech, materials, and consumer cyclical discretionary. Are those safe bets to continue? Is that where this is going? It's basically a risk-on reflationary trade.
I hate even the thought that there's anything safe, and I think holding CDs or gold is just insane. But I know what you mean, Larry. The question is, are we going to put the risk trade back on?
Right.
The reason why I went to cash, and the reason why I'm saying I think the S&P goes sideways for a little bit into the quarter, and you just turn over your stock, you just turn over your sectors, is because I think there's some real concern. The S&P, for you technical analysts out there, it broke some critical uptrend lines, and I tell you, this 40% fast reduction in the volatility in the VIX index. I think for most traders, people think it is strange, it is emotional, and I think it's a warning sign, not a positive, comforting thing to say, hey, the market's not so volatile, we're fine. It's the speed at which the VIX came down and the speed at which people are willing to put on that risk trade. I'd say just be cautious for a week or two. Why can't everybody just ring their cash register, show their performance?
I'm not being critical of your cash call. I have so much respect for you. I just wanted to hear where you were thinking now. That's the point I made that. It was not a criticism. Martin Weiss.
Oh, no, listen. I'm not critical of it all. I think you just have to, I think people need to take a break.
This is a tricky moment.
Going into risk.
This is a very tricky moment. Martin Weiss, let me ask you. We all seem to agree the Fed is playing a major role here and profits are playing a major role here. What about the dollar decline and the inflation rise cutting into profits? In other words, is that something that the market is? Can you have profits continuing to rise with this commodity bulge and inflation bulge, Martin, that may take profits, if not lower, certainly profit margins will be squinched down quite a bit? Is that something that investors should be thinking about?
That's something that will impact profits, but the bigger and more direct impact is going to be on Treasury bond prices and on interest rates. And then the interest rates is what really would bite, not only in the housing market, which is so vulnerable to higher interest rates, but across the board. Like a tidal wave, interest rates, if they're rising fast enough, can have a tremendous impact on profits.
So you are a skeptic of this rally, and I'd like to know how you are playing it.
The way to play this market, in my opinion, is to be extremely selective and to hedge. And to have a big cash position. So that's a three-part strategy. Number one, buy stocks that are conservative, give you a good dividend cushion. Number two, have hedges against the broad market to protect you against a major broad market decline whenever it may happen. And number three, a big stash of cash.
Right.
And of course, if you're holding cash in dollars, you have to offset that inflation risk and that dollar decline risk with some precious metals or some anti-inflation hedges.
Mike Cuggino, I got 20 seconds for you. Are you in the reflation play? What's your favorite investment?
Yeah, I am. The U.S. stock market, and we still like commodities and energy and those harder stocks. I also like financials because they've been beaten down. Technology, transportation stocks for the global growth story.
Those are the leaders.
So we're all over the place.
Those were the leaders. Gentlemen, thank you very much. Michael Cuggino, Lee Munson, and Martin Weiss.